We're here to talk about the Silicon Valley real estate market for the week ending January the 10th, 2025. These are the key chapters we're going over. The graphics correspond. You can jump to the section that you find the most interesting. I really like the micro market for impacting clients' decision on whether to buy or what price to ask or offer. Anyway, let's get into the data. Here's the first data slide. This is sort of a summary of some of the key indicators for the past 13 weeks plus the current week. You can see that we start off with inventory. Inventory is extremely low, but it's extremely low at this time of the year where we only have 1,080 listings for all of Silicon Valley. That's San Mateo County, Santa Clara County, and Alameda County. That's 88% of where we normally are. So we're missing 12% of our inventory. The concept here is the gray line is the typical based on the previous 10-year median. The red is the least or the hottest. Less inventory favors the seller, red favors the seller. So that's your lowest inventory you'd expect. The blue line's the most inventory you'd expect. So you are between the least inventory, about midway between the least inventory and the typical inventory, but there is definitely a shortage of inventory. But you can see, the inventory normally dips down at this time of the year. Moving on and doing the same thing with offers. You can see offers is now below the blue line. So we're having less offers than you would expect based on the past 10 years. And then the blue line is actually the 10 percentile. So there is 10 percentile the times that, basically 1 year where you're going to be lower. So we are sort of at the least you'd expect, and we'll be seeing that later on when we talk about the number of offers accepted. The days of unsold inventory, this is the turnover rate of the marketplace. It's a theoretical number, but it tells you how much pressure the buyers would feel when they go out there to buy. You can see that right now we're a little bit above the gray line, but you can see last week we were a little bit below. So there's fluctuation. Every holiday impacts real estate. The more significant the holiday, the more the impact is. So at this time of the year, we have huge swings. And what I'd be expecting is more inventory coming on the marketplace, which happened this week. As you can see, you went up from last week. I would expect not more offers this week, and you didn't get more offers this week, but I would expect more offers next week as the result of the increased inventory this week. In other words, the inventory has to come on the market for a weekend before the buyers have the opportunity to make their offers for the most part. Your days of unsold inventory now is going up. And the reason it's going up is you have that increased inventory already. So that's reflected in the data, but you haven't had the corresponding increase in offers. So I'd expect this number to go down next week. This is comparing to where it typically goes down, and that's when the calendar comes in. So basically, you have fluctuations, and that's what we have. You can see that you were, for several weeks in a row, you were slightly above, then you dipped slightly below, now you're slightly above. I would basically say, as far as the turnover rate of the marketplace, is completely normal. A similar measurement of the turnover rate is actually marketing time. This is the 75th percentile. How long does it take 3 out of 4 sellers to sell? The reason I'm using that benchmark is a fair number of sellers come on the marketplace and sell their home the first week. That's roughly 50% of the marketplace. Yes, it increases a little bit higher in hot marketplace. It goes a little bit lower in slow marketplaces. But for the most part, almost half our marketplace is selling as soon as the seller will accept offers. So I'm basically ignoring that and focused on from the 50%, which is the median, to 100%. And in the middle of that is the third quadrant, or the 75th percentile, which is how I came up with that number to look at. You can see we were quite a bit above the blue line for a couple of weeks now. And right now we're basically right on the blue line. So you sort of, the longest marketing time you'd expect, that time frame right now is 47 days. You can see that it's 15% longer than it typically is. Price reductions. This is looking at the seller reducing their own asking price before their offer comes in the door that they ultimately accept. The reason this number is so small, slightly less than 1%, so let's call it 1% for easy talking, you have a 1% reduction. The reason that number is so small is it's not that sellers are taking a 1% reduction. It's basically some number around 85% of the sellers are taking no price reductions whatsoever. So the 15% of the sellers that are taking price reductions are on average taking a price reduction somewhere around 7-8%. The sellers that are taking price reductions are taking significant price reductions, but it's the fact that so many take zero that this number is so tight. Where are we standing? We're basically right at normal. You can see how close we are to the gray line. Yeah, you're a little bit lower, but you're nowhere near the blue line and you're clearly nowhere near the red line. So again, as far as price reductions, sellers are taking about the normal amount. Next, we're looking at overbidding. Overbidding is really not an indicator of the marketplace because you need to get the sold price. Therefore, it lags behind the marketplace. At this time of the year, it lags behind by about 5 weeks. Basically, maybe 8 weeks from now, it will only be lagging behind by about 3 weeks because as the market gets more aggressive, buyers try to go in with shorter and shorter escrows, even though they're very stressful to accomplish. They are possible. But overbidding right now is 4.7% above the seller's ask price. Typically, it's 3.3%, and that's why the purple line is above the gray line. So right now, sellers are getting 1.4% more above their asking price than they typically do at this time of the year. Real estate is very seasonal based on the calendar year, and then even within the week, it's very cyclical. Whether you're on a Friday when you basically have the most inventory for the week, and then Monday and Tuesday, you have very few new listings coming on the marketplace. By Wednesday, you're starting to have new listings coming on the marketplace and a lot of sales. So there's a lot of fluctuations that happen based on what happens in the real estate marketplace. This now is giving you a long-term look. You can see just in the last couple of weeks, the inventory here in the purple has shot up, and you would expect that. Basically, people were waiting for the New Year's to be here and over with, and then boom, you got a significant increase. But this is an increase compared to normal, and that's just most likely the cycle that we're in. New Year's this year was on a Wednesday, but you've gone from basically some number around 74% of the inventory you'd expect to 88%. So that's a huge increase. But again, at this time of the year, those timing becomes an issue. And I think that's the timing. I think that's why we went down so far and came back up. If you look at this, you're basically right at that high 80%, somewhere around 88% that we have been for some period of time when you sort of look at this graph on a big scale. Same thing's happening with the turnover rate, the days unsold inventory in the gray here, in large part because of the increase in inventory. Since you can see here, offers really didn't go anywhere. They, if anything, they went down a little bit, which combines with the increased inventory to really increase your days of unsold inventory. I would expect this number to come flying down next week because we have more offers coming in. And you can see the offers on the orange down here. It's only at 72% now, which is a very low number compared to the available inventory. But that's because that inventory hasn't been able to accept offers yet or unwilling to accept offers yet. Again, I would expect this number next week to shoot back up significantly, probably somewhere around the 80 percentile mark. Now what we're doing is looking at each component. Here from January 1st of 2015, way back on the left-hand side, through December 31st of 2023, I have what I call my condensed scale. It's roughly half the distance for each quarter. And then when you get to January 1st of 2024 through 2025, for 2 years, you're on the expanded scale. The expanded scale is so you can see the trends a little bit better. You can see these valleys, all four lines actually, because you know that a lot of these trends are holidays. Like this one right here is probably July 4th, happens at the same time every year, so you can see the trend happens fairly closely. Just guessing, this is probably Labor Day, so you can really see the impacts of holidays on there, and I probably could pick out some more holidays. By seeing the expanded trend, you can see the annual trends. Anyway, we're down here, we have limited inventory. We turn around and we went up like we normally do. Notice how the red line goes up, the gray line goes up, the blue line. So you have limited inventory, but it's following the normal trend, just with less inventory than expect. Here now is taking that gray line, pulling it out in a straight line and saying that inventory right now is basically at 90% of the level of inventory you'd expect it to be. So you can see we've had a shortage of inventory for several years now. And then the last time we really had any surplus was back here in 2019 before the pandemic. And there has been basically a shortage. Even during our slowdown, we basically just barely got up to normal levels. Here's looking at the same graphs for offers. It's going to be the same paragraphs. You can see that offers have come down here. I would expect offers to turn around and be up next week. This looks like we have 1 week longer. I think, again, that's because of where we are on the calendar. I suspect that we will actually see this number turn up a little bit early compared to the blue line. Only time will tell, but again, you can see that you've been following the blue line for a fairly significant period of time. Yes, you had a little bit of increase here during fourth quarter of last year, which would be basically, the October, November timeframe. By December, we were back down to the least amount of offers you'd expect. Whoa. Here you can see the offer, same concept, pull out the gray line. You can see that we're low on our number of offers at about 72%. You can see we came down. I expect this will go back up next week. And so next week we may be significantly, maybe even above 80%, because I think we're going to be coming up sooner than the 10-year median would indicate. Here's your days of unsold inventory. So that theoretical number, you can see that's been following the gray line very well. You got to come all the way back here to second quarter of 2004 before there's any real separation. But basically from fourth quarter all the way through fourth quarter, and now even over the holidays, it's been following that gray line very closely. So the speed of the market, the pressure buyers and sellers are feeling, is typical for Silicon Valley, which in recent history, since about September of 97, if I'm remembering right, we've been in a very much a seller's marketplace for the most time. Yes, there's been a few years worth of exceptions, but the general period has been a strong seller's marketplace. Here's the days of unsold inventory. You can see that it went really up. Again, it went up because of the increase of inventory and not yet having the time to have the associated increase in inventory. Here's the marketing time. You can see marketing time looks like it's just rolled over on this purple line. I don't want to hide the data with my pointer, but you can see it was climbing up quite rapidly and then rolled over. Last week we were up quite a bit higher, but that did turn out, as I speculated partway through the presentation, is I was plotting 83 percentile instead of 75 percentile. So the data for 83% is going to be much higher than it is for the 75th percentile. That's basically what, 5 out of 6 sellers, if I got my math right, instead of 3 out of 4. So I was off one column, and that's why the numbers were so much higher. And I did point that out just about this slide, most likely. So the big takeaway here is I think that the marketing time's rolled over, and I expect that to come down as it comes down typically every year. Using the gray line would be a good pattern to use on all these. That's where you'd expect the market to be going from wherever the purple line is at the current moment. Here again is the same concept to pull out the gray line straight. You can see that right now the marketing time is about 15% longer than it normally is for this time of the year. I don't know which way to expect it compared to normal. I expected the marketing time to go down, but it may go down faster or slower than it normally does. So this number on this graph doesn't have to follow the pattern on the previous graph. Here's your largest 10% price reduction. I talked earlier in the first data slide about how most of the sellers don't do any price reduction at all. In this case, I'm ignoring 90% of the market and only looking at the 10% of the sellers that are taking the largest price reduction. What are they doing? So here you can see that the sellers that are taking the largest price reductions are taking a 13.5% price reduction. Their ask price at the time the offer was accepted was 86.5% of their original ask price. If you take off 86.5 off 100%, that's the 13.5% price reduction they're taking. Here's compared to normal. You can see they've been taking more price reductions than normal, probably somewhere right around 15% higher price reductions than they normally do. So if they were taking a 10% price reduction, that 10% would become 11.5% instead of the typical 10%. Here is the average ask price. So I put this in there to show you the same data, but now you can see that the average ask price reduction is that less than that 1% that we were talking about. I think it was 0.95%, and that looks about right. So that's not far off of where you'd expect it to be. It's a lot closer to the gray line than any of the two lines. So basically, you would say that the seller price reductions are typical for this time of the year. And here you can see that we're basically a little bit more than typical on this graph. It's a little easier to see, but still fairly close to normal. Here's now looking at the seller frequency. So the last two slides were magnitude of price reductions. This now looks at the frequency of price reductions. And you can see, yes, there was a little bit less normal price reductions here partway at the beginning part of the fourth quarter, we're basically at normal. I would just call this statistical fluctuation and say that the frequency of price reductions has been fairly typical all the way back to early in 2023. 2023 and the latter part of or 2022, price reductions were way more common. You can see right here, this was during our huge slowdown that I believe actually started about February 14th, midway through first quarter of 2022. Here is looking at the same thing, pulling out the gray line. You can see right now we're taking less price reductions according to this graph. We're taking 80%. And you can see that you are on the downhill side and it's a vertical separation. You know, it looks close here, and that's actually what I said. And then you come over here and it's 80%. So you're getting 20% fewer price reductions than you normally do. And that's why I plot it both ways. It's the same data, just plotted differently. And the way you plot data helps or hinders you from seeing trends. Here now is the magnitude of overbidding. This is, you can see that, and this is the median. The slide we were looking at earlier was the average overbidding. And so here the median overbid is about 1.5%, quite a bit smaller. I forgot what the number was. Maybe it was 4.9%, maybe 4.7%, something like that. That's the average. This is the median. So half the buyers overbid more than 1.5%, half are less than 1.5%. And again, you can see it's above the gray line, so there's more overbidding than typical based on the median and on the average. Pulling it out straight, the gray line, and now you can see that your overbidding is up here somewhere around 1.5% more overbidding than typical. And here's the frequency of overbidding. This is how common is overbidding. Slightly more common because red favors the seller, so red would be a lot of overbidding. You're on the red side of the gray line, but it's basically following the normal pattern of gray. I would be close enough to say overbidding is as common or uncommon as it typically is, and it's basically somewhere around 58% of the sellers are getting more than their asking price. And on big ticket items, it's pretty uncommon, you know, especially on home prices. You go anywhere else in the country and say half the sellers are getting more than their asking price, and they'd look at you cross-eyed. Here's the frequency. So it's a little bit higher than normal, about 7% higher overbidding, more frequent overbidding. And that's not 7, that's, you know, again, this is if it's normally at 50%, it would be at 53.5%. That's 7% increase of the 50%. Here now is looking at your long-term pricing. This is on log paper. You can see that it looks like it turned around. Here's your payments. These are the payments. This is based on interest rates. Interest rates went up a very small amount. I forgot what the exact numbers were, 6.91 to 6.93, I think, from memory. So in order for this to be coming down, that means prices on the high end went down. This is the 90 percentile, the most expensive 10%. They're basically looking at payments around $25,000 a month if they did an 80% loan, and it includes property tax and insurance. The typical home down here is the median. The monthly payment there is just shy of $12,000 a month, probably about $1,180 or $1,175. And the cheapest, most affordable in the 3 counties is down here just over $6,000 a month. Here we have distributions. I have changed this with the new year. You start off going every week. And the reason every week's important, that's where the market trend is going to be. So let's look at this. You're on the purple line, which is where we are right now. The dotted gray line, which is bolded through right through here, is where we were a year ago. We're going to start off on the gray line, and you're going to watch the dotted lines and see if they go up or down, because that would be a good indication of which direction you'd expect the purple line to go. Now, my expectation, without having seen the data, is for this to go down. It may actually go up for the first week, and then after or about 6 weeks, I jump over and look at every 2 weeks, and then I come back and look at 1 week again. So let's step through. It did look like it went up a little bit there on the dotted yellow line, and then it went crashing down on the blue line, the green line. Basically, you could almost say that you'd expect this purple line to go up or flat 1 more week and then down. I would actually expect it to go down. You're on the brown dotted line now, right there, sort of the peak of the marketplace, and right there's the peak. And now it's sort of slowing down already for the summer. And they're right there on August 2nd. You're sort of not really going anywhere. You're bouncing for quite a while. Right there, November 8th, you start slowing down. And then you had to speed up, and now you're slowing down. You're up here on the gray line, yellow line. So basically, this allows you to see the shifts and also where you typically are. The coolest marketplace is the blue line. The hottest marketplace is down here on the red line. You can see the pattern. The dotted lines are the oldest lines, then the dashed lines are the next, and the solid lines are the most recent. And that's the concept for the next two groups as well. Here we're looking at price reductions, so you can see the distribution. You can see that last year you were down here on the dotted line. You're taking much smaller price reductions because up here is 100% no price reductions, and we actually accomplished that on Valentine's Day of 2022, which was basically the peak of the marketplace, and that's when, in my opinion, the market shifted. Here's the worst that we had, which was basically Christmas of 2022. So we're stepping through. You can see you're down here on, and now you're turning around and accelerating. So one more down week. And again, I don't expect that down week to happen this year. Now you're moving up towards the peak. You got a couple more weeks to go. One more, there's the peak. Now you're already back to the peak. So there's some weekly fluctuations. And now you're basically down in the summer doldrums where there's really not change. And that was about middle of July. So each metric has a different pattern. So you have to pay attention to what metric you're looking at. And this again is where the sellers take the biggest price reductions. So right there is a couple weeks ago, the 20th, the 27th. So you can see there's a little bounce. Now there's already less price reductions. So it looks like the price reductions have already started to become less common this year, even though that last year, a year ago, you were sort of at the bottom. We've already even hit bottom and looks like we're seeing less price reductions. And again, that's the sellers that are taking the largest price reductions. What I think actually seemed to happen from the data was right after Thanksgiving, there was a large number of sellers that took larger price reductions than would be typical, and that cleaned out the marketplace. And I think that may be why this number's acting sooner this year. And the last one is overbidding. Now here, because the timeline for escrows, I'd expect the market to go down cooler for a couple more weeks, and you'll see that. Again, the purple line is where we're starting on. Well, we're starting on the orange dotted line, but the data is actually up here. So which direction does the data go? You can see it can come down a little bit because you can see the fine lines here, and you'll see them in a second right there. 2 weeks, 3 weeks, 4 weeks, and then 5 weeks is a little higher than it currently was. So basically, you can expect a couple more weeks downturn. Then you're coming up right there around the middle of April is the peak of the marketplace, and then you're coming down. The peak of the marketplace doesn't last very long. And then right here again in July, end of July, beginning of August, you sort of hit the summer plateau where you don't really move. So even though I would expect the data to more overbidding as far as offers accepted, because we don't know that data, we have a blind spot while escrow's closed, I'd expect the data to actually get cooler for a couple more weeks, probably around 3 or 4 more weeks before it accelerates, even though the market's probably accelerating as we speak. Here now is comparing the 3 counties. Here's January the 3rd, here's January the 10th. So all 3 counties have seen an increase in the active listings. Here's the offers accepted. We don't have the weekend yet from that increase in active listings because that's only 1 week. So I'd expect all 3 of these to turn around and go up next week. It is interesting that the offers accepted right here for Alameda County and Santa Clara County are basically identical. If you come back here, Alameda County has more inventory than Santa Clara. So when we come to this next slide, I'd expect Alameda County in the gray to have a much slower, longer turnover rate than Santa Clara. And that's exactly what we have. Santa Clara is down here at somewhere around 35 days. Alameda County is up here at about 54 days, and San Mateo is at 48 days. That, again, is the theoretical number to sell all your existing inventory. Here's marketing time. Again, Alameda County, it's in the same order. It not always is, but Alameda County has the longest marketing time at 58 days. That's how long it's taking right now for 3/4 of the sellers to get their offers accepted. San Mateo is a little bit better at 52, and Santa Clara is the fastest county, way down at 32. So Santa Clara County has a much faster paced marketplace than San Mateo and than Alameda. And if you come back historically before the pandemic, you can see we were much closer together. After the pandemic, the orange line, San Mateo, sort of became the slowest county. And, I can't say it was the fastest, but a lot of times it seemed like it was the fastest. And almost always had the fastest turnover rate, days of unsold inventory, even though it didn't always have the lowest, fastest days on marketplace. Here now is the magnitude of price reductions. You can see that Santa Clara County is doing the least amount of price reductions. It's just over half of 1%. San Mateo just over 1%. And Alameda County is about 1.6% price reduction, and that's average. So that's that small number. Here's the frequency. Santa Clara County has the least at just about 13% of the sellers are taking price reductions. That means 87% of the sellers in Santa Clara County are not taking any price reduction whatsoever. San Mateo County is at 15.5% of the sellers doing price reductions, and Alameda County is at 20.5% of the sellers are doing a price reduction. Overbidding, very close together. This is the average overbid. San Mateo County has the least at basically 4% overbidding. Santa Clara County has the most at 5%. And then Alameda County is right in between at 4.5%. So very tight metric, basically 4 to 5% is the average overbid. This is the frequency of overbidding, and basically they're all right between 55% and 60% of the sellers are getting more than their asking price. So just over half the sellers are getting more than their asking price, and that's on offers coming in. Here's the long-term appreciation. Santa Clara County has the highest of the three counties at 90. San Mateo County has the lowest at about 47%, and Alameda County is right at 60%. You can see they were all fairly close together before the pandemic. After the pandemic, San Mateo County went down. Alameda's initially was having better, and now it's basically very similar to San Mateo, but clearly Santa Clara County has the better appreciation rate out of the three at, 20% higher, 25% higher appreciation rate. Here are your prices. Notice again, Santa Clara County is now the highest priced county. And also, not only is the trend reversed of normal, the magnitude is fairly high. Last week, and I think even the week before that, typically San Mateo County, you can see historically was always higher. And then we had a few times here where we were basically equal, and then one week here where we were below. And now we're below by a significant amount. I think these are long-term trends based on moving and job placement and also increased remote working. There's no need to pay the premium that San Mateo County used to have in 2015, and that's my base year. And if the base year was high compared to current market conditions, that's going to give you a lower appreciation rate. Here we're talking about just price. So now if you go to San Mateo County, you might be able to get more house for your money. At least the median price of the home is less in San Mateo County. And I have taken a couple clients out of Santa Clara County and put them in San Mateo because they felt they got more house for their money. And that's going back several years already. Here's the same information on regular paper for those that prefer. Moving on to estimated payments goes through the same formula. So the order is the same. Santa Clara County now the most expensive with $14,000 a month payments. San Mateo County at $13,000, and this is for the median priced home in the county, and Alameda County at $9,000, and that includes an estimate for property taxes and insurance. This now is simply looking at the micro market areas, and this to me is important. This is looking at it compared to the 10-year median. For Alameda County, I don't have the 7 micro market areas for the first 3 slides, but for the next 9 after that, I do. But basically, you can see the active inventory is a little bit on the pink side, which means you have less inventory than you expect. And if you just scan these numbers, they all look like they're right somewhere around 80% of the inventory. You can see Silicon Valley is at 90% overall. Santa Clara is at 76%. San Mateo County is at 97%. And Alameda County is at 85%. So this one slide is a good example on why it's important to look at the data at a fine-tooth level, because one number doesn't reflect what's happening in every specific area. Moving on, I'm doing the same thing with offers. Notice the huge amount of blue, clearly a lack of offers accepted. And that's just the way it is right now. There's not very many sellers. There's not very many buyers. Here's the ratio. So the speed between the two, I would say this is more blue than pink. So right now the market's a little bit slower. I think there's a very good chance this could change significantly once we get a week or two past New Year's. This is days on sold inventory. Now we're dropping the 10-year median and just doing what the raw count is. In red areas, you're going to have a hot marketplace. In blue area, which is going to be the expensive areas in San Mateo County, you have a slow marketplace. 177 days basically to sell out their inventory. Now you're looking at days on market. So this is marketing time, a little bit more blue here. So it might be a better reflection of what the market's doing than days on sold inventory. It's a newer metric for me, but you can see areas like Hayward is fairly blue. Half Moon Bay, the coast is very blue. 150 days for 3/4 of the sellers to sell. I'm doing my math real quick. That's almost a half a year. That's 5 months for 3/4 of the sellers to sell. 3 months in the rich areas of San Mateo County. And then you get down to the other extreme with only 10 days. So a week and a half for 3/4 of the sellers to sell in Cupertino and Sunnyvale. House price adjustments, a little bit more balance here. You can see the coast is really taking price reductions. And then you can see Pacifica, Alameda County overall is taking price reductions, Oakland, the affordable areas in San Jose. But then there's, again, some areas where they're actually going up in price. Milpitas raised their price 0.1% before they accepted their offer. Here's the frequency of those price reductions. So price reductions is very uncommon in the red areas, more common than the blue. So a third of the sellers in the coast over here by Half Moon Bay are taking a price reduction before they accept their offer. In Oakland, it's about a third. In Morgan Hill, it's about 30%. But then you get to Cupertino, only less than 4% of the sellers are doing a price adjustment. Here's the magnitude of overbidding. So this is how the pressure the buyers are feeling. They're not feeling the overbidding. In fact, they're taking another 1.5% off the seller's ask price on Half Moon Bay, but everybody else is going up. Morgan Hill is down almost 1%. The expensive area is down 0.6%. But then, Cupertino, Sunnyvale up almost 10%. Campbell up 8%. Berkeley, city of Alameda, up 13%. So there is a wide variation, and buyers are willing to overbid when they need to. Here's the frequency of that overbidding. Pleasanton is some of the lowest. It's 1 in 4 sellers are getting an overbid. Same with the Half Moon Bay Coast and Morgan Hill. So the 3 blue areas are all very close together with about 1 in 4 sellers getting overbid, which is still significant. But that means 3/4 of sellers aren't getting overbid versus Cupertino, where almost 3/4, 71% are getting overbid. Berkeley is slightly higher at 74% getting overbid. So you can see in a nutshell, sort of the more affordable areas on a global market are where the hotter marketplaces are as far as overbidding. Here's appreciation. It really tells a story. Here's where you've gotten the best return on your investment in the red since 2015. The blue is where you've gotten the least amount of appreciation since 2015. It is noteworthy that Oakland, the island of Alameda, and Berkeley, this top blue. Oakland is the second blue. They're not completely geographically correct, but that's so they fit on the map. This is basically the Oakland airport down here, and this is the island of Alameda. But you can see where the appreciation's happening since the pandemic. Here's the prices, and instead of following the median number, which is the middle number, I add in the 10 percentile and the 90 percentile, so you have some of the idea what the price range is in the different areas. You can see where the expensive areas still are and where the more affordable areas are in the blue. Here's a summary of the slides. You can start over on the left-hand side if you know what micro market area you're interested in, or you can start off on the right-hand side and start with the payment or the price range after meeting the lender, read across and see what your market conditions are. The yellow highlight is sort of your leading indicators. Overbidding, again, is a lagging indicator, and that's why it's in orange. And ignore the date up here. Apparently, it's not getting updated because I know the data is updated. Here now is the actual raw data for Santa Clara County, San Mateo County, and Alameda County. You can see whatever data is most important for you. You can see the huge increase in inventory. Overall, 10% increase, 14% in San Mateo, 12% in Alameda County. Number of new active listings is up significantly, almost 20-25% across the board. Number of offers are down. I expect that to turn around next week. Days of unsold inventory is increasing because you have more inventory and less offers. And with the rest of the data, you can pick whatever is important to you. This is important down here at the bottom line, and it's changed. We've had a fair number of transactions fell through. These two lines are incorrect, but the bottom two lines are the real takeaway. We're having the least number of offers accepted, 10 out of the 10th least number of offers, 25th out of 25 past years. You can see the numbers are close, 943 last week to 932. This 932 will continue to decrease. This 842 will start decreasing next week as the TFTs come in. With that, we've been talking about the Silicon Valley Bay Area will be next, 13 counties and 5 regions. The blue gets you to the archive on YouTube. So does the green root URL, that's shorter typing. To get to the live presentation Saturday morning, you type in the green root URL plus the year 2025. The handout is up if anybody wants it. Green root URL, H for handout 2025, 01/11 for today's date. Past episodes in 2025 or 2024. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information representing buyers or sellers in Silicon Valley here. Appreciate a subscription and a like on every video. And let me see if I have any questions. I'm not seeing any unmuted mics. Here are the 5 regions. The first one is Silicon Valley that we've been talking about, Santa Clara, San Mateo, and Alameda counties. Then we have the cities, San Francisco and Marin, North County, Sonoma, Napa, Solano, and Contra Costa. Central Valley, San Joaquin and Sacramento, and Santa Cruz and Monterey make up the Central Coast. We are using the 10-year period of 2015 through 2024. Let's get into the data. You can see that inventory in all 5 regions has increased. So last week was our least amount of inventory, which is fairly typical. You can see that January 1st basically is the bottom of the V in all the years we have data displayed. Looking at the number of offers is down in Silicon Valley. It's down in the cities, which is what I would expect. Note it's flat in Central Valley. It's actually up in North Bay, and it's actually up in the Central Coast. So the two areas that had sort of longer marketing times, more inventory compared to normal, have actually seen an increase. I expect the remaining 2 areas, the cities and Silicon Valley, will turn around next week when their limited inventory was increased by the new inventory that came on this past week. Here's your days of unsold inventory. And basically, because the inventory is now up, and at least in the Silicon Valley and in the cities, you haven't had time to sell that new inventory, so your sales are still low. That's caused your days of unsold inventory to go up fairly significantly. It dips for the holidays. It dips going into the holidays, and then coming out of the holidays, it goes back up. The other 3 are basically increasing except for the Central Coast. The Central Coast is the highest, and it's basically dipped down. I would actually call it flat. The others are 2, being the Central Valley and the North Bay, are at a slight increase. Increasing days of unsold inventory is a slowing marketplace. Here's marketing time. This is the time it takes 3/4 of sellers to sell their properties. You can see the cities has a long marketing time at 84 days, followed by North Bay at about 76 days. Central Coast and Central Valley, both on both sides of 65 days. And the area that's moving the fastest is the Silicon Valley area at something like 47 days for 3/4 of the sellers to sell their properties. Here is price reductions. This is how much the sellers are reducing their asking price in the different areas. The area that's reducing their price the most is the Central Coast at just over 3%, 3.5%. Then you have the cities and the North Bay pretty close together, about 2.5%. Central Valley at 1.7%. And the area that's doing the least amount of price reductions is Silicon Valley at just shy of 1% price reductions. That's average. The reason the number is so small is the vast majority of the sellers do no price reductions whatsoever, so giving you a whole bunch of zeros. Here's looking at the frequency of the seller's ask price. So how common is it? The standout is Silicon Valley, with only something like 16% of the sellers doing a price reductions. The other 4 regions are grouped very close together at right around 1/3 of the sellers doing a price reduction. So basically from maybe 33 to 35% for 4 of the 5 regions. This is the average overbidding. We've talked about the average and the median, both depending on which slide we're talking about. This is average. You can see 3 regions being the North Bay, the Central Valley, and the Central Coast, all right about 100%. And then you have the standouts being Silicon Valley at about 4.5% above the seller's asking price, and cities at about 5.25% above the seller's asking price on average. The medians are much lower. This is the frequency of that overbidding. So how widespread is buyers overbidding? Silicon Valley is the highest at 58%, followed by the cities at just over 50%. Then you have North Bay at 40%, and the Central Coast and the Central Valley very close to 33% each, or 1 out of 3 sellers getting more than their asking price. This is long-term appreciation. The big standout here is the cities. San Francisco and Marin has the lowest appreciation. Very noteworthy departure, basically, with the pandemic. You can see historically they were all grouped fairly close together. Or Silicon Valley had the standout year in 2018, but fairly close together. Now, obviously, the cities is doing the least well, followed by the North Bay. And then you have the Central Valley doing the absolute best at a basically 86% appreciation. And then you have the Central Coast just under 80 and Silicon Valley at about 74% appreciation. That's since the last 9 months of 2015. Here's your median sold price. You can see Silicon Valley is the most expensive region now at about 1,550,000 maybe. And then cities is coming in second place at about 1,450,000. So about a $75,000 delta between the two, which is much bigger than normal. Normally, San Mateo County is the most expensive. When Silicon Valley is the more expensive, it's usually by very close to a tie. This is one of the biggest differentials I've seen. I think last week was 100,000, and that was the biggest, I believe. Then you have Central Coast down here at about a million one, North Bay at about 800,000, and the most affordable region is Central Valley at 550,000 for the median sold price. Here's the same information basically, but converted to monthly payments. So you can see that the order is exactly the same. Silicon Valley is going to have the highest monthly payments. Central Valley is going to have the lowest monthly payments. This assumes an 80% 30-year fixed loan at the national average. Here are the actual numbers for the metrics across the top, the different regions across the side. And I don't have the regions, I have the counties. I do have Silicon Valley as a region, and I have the Bay Area as a region. I don't believe the Bay Area as a region is a valid number, but I included simply because the media does, and to let people see why it's such misinformation. Just look at the marketing time of 88 days. It varies from a high of 132 days in Napa to a low of 50 days in Silicon Valley. The one number of 88, in my opinion, doesn't reflect what the market's doing. In fact, a lot of the market's down around 80 days, and that might be a more accurate market. You got one market around 80 days, another market around 120 days. But no matter how you slice it, I don't believe throwing in 9 counties that happen to touch the Bay and analyzing that tells you what's happening in any given area. And that's also why I'm a firm believer in the micro market area. I don't even think knowing what's happening in the Santa Clara County area tells you what's happening in Los Altos or Milpitas. It's all about real estate being local. That's why I invented micro market data. And with that, we're finished with the presentation. I'm not seeing any questions. Again, these are the different chapters. You can jump to the section you like week after week. Please subscribe and to like my video. I appreciate it. Thanks. Have a great week. Take care. Bye for now.